Good afternoon. This is Lydia Tate, lydiaspeaks.com. I am here to continue our conversation on paying off our debt. So the last session we talked about the debt relief program, but somebody asked where to find me. You can find me on my website at lydiaspeaks.com. You can also reach me on coaching at lydiaspeaks.com. Again, coaching at lydiaspeaks.com, or you can go to my website, Lydia Speaks, LYDIAH, speaks, one word.com, and you will find ways to reach out to us for just additional resources if you're looking for additional resources to get out of debt. So this afternoon, I'm coming back to you to continue our conversation on paying off debt on our financial website, wellness education here. Today, I will focus on debt consolidation. We spoke about the debt relief program, which, to just summarize what that is more of a permanent program than what the debt restructure is. The debt consolidation program is more so of a debt restructuring program where you pay off your debt with a lower rate and simplified terms, and can help you with resolving some of those high interest unsecured debt payments that you may have out there. So that is just the biggest difference between the two. If you want to learn more about the debt relief program, check out the most recent YouTube video that we did. But today I'll start by focusing on the 6 W's of debt consolidation. The 6 W's of debt consolidation. Excuse me, fighting something here, so I'll probably clear my throat a few times, but bear with me here. I'll finish this session. By God's grace, I will. So the 6 W's of debt consolidation, one of them is what? It's usually a matter of rolling up several debts into one bigger loan than just, one bigger single loan. So that's really what it is. And then who qualifies for that? We'll talk about, if you qualify or somebody else qualifies for it. And then when can you apply for it? How, where can you apply for it? Where can you find the resources to do that? Why you qualify, why you can apply for it, why people choose to do debt consolidation, and then why not? You could end up paying more in the long run if you don't do a debt consolidation. So those are just my 6 W's: what, who, when, where, why, and why not. And to kind of give you a little bit of statistics here about the American millennials. If you're like me, you have millennials, or you know somebody who has kids who are born during that year, the year of the millennials, and now they're adults and they're trying to figure themselves out. And this could be good information for them as much as it is good information for you, because ultimately we're trying to, if you're a parent like myself, you're trying to make sure that your kids are okay while you're here. When you leave, that they've made good decisions with their finances, and that they teach their children to make good decisions too. So there is a study here that shows that American millennials spend about a third of their monthly income on repayment of debt. So this is according to a report that was recently published by financial services companies. So a third on repaying debt is quite substantial. And so if you're a millennial, you're probably juggling multiple debts, including, studies show that most millennials are like 21% of millennials, 21% of millennials have personal loans that they're trying to manage. They have 20% are struggling with credit card debt, 11% have mortgages, and loans to pay for education will be 7%, and 6% car loans. So these are some of the debts that millennials are struggling with, which I think is a really good study that gives us an idea. And if I think about the debts that my millennials carry, for instance, this is not far from it, even though they have managed their debts quite aggressively, because we talk about these things quite often at home. We talk about credit, we talk about finances, we talk about how to pay off debt, we talk about savings. So what I'm sharing with you today is a practice that I have at home, and that my family, even my children get to learn about. So if you're a millennial, this is great information for you. You have to prepare yourself for the future. Maybe you want to prepare for home purchase, or you want to prepare for marriage, or some other large project that you're preparing for, and you happen to be in a lot of debt. This may be a great opportunity for you to maybe try and change that if you qualify. Again, we're talking about the 6 W's. Along the way, one of the W's may apply to you and may be relevant to your situation, and this may be a good program for you. And if it's not, there are other programs out there. We've spoken about some of them, and I hope that that this information is a great resource to help you improve your financial situation. So, what is a debt consolidation? What is a debt consolidation? Debt consolidation is simply where you take all your unsecured debt, including credit cards, personal loans, maybe financial store loans and cash advance loans, and you put them into one simplified loan with a lower rate and even a better term, better length of repayment. So these loans can be available through your financial institution. They can be available through fintech companies. You just have to do your own personal research and find out which one of those organizations works best for you. I know that typically most credit unions are very good at this. A lot of the larger financial institutions may not necessarily have this as an option unless you're considering doing a home equity line of credit and taking out cash from your house to pay off these debts, or you have some sort of collateral, something that the bank can use to as collateral to lend you money to pay off your unsecured debt. But typically, the first stop would be to talk to your bank, and talk to them about debt consolidation, or talk to them about lowering your rates on your credit cards, or agreeing on a term that would work. And I've talked about this before, that I've seen where a financial institution will work with a client to perhaps give them a fixed rate on their credit card so that they're able to pay off that debt faster. And a lot of the larger banks are very good at doing that. So you want to consult with your financial institution and be honest with them about your financial position. Let them know what is happening with you right now, and that you're not able to afford to pay the debt at this moment, and they would find a program that works for you, because it's honorable to let them know, and it's honorable to pay your debt. So when you consult or contact a bank to discuss your credit card debt or whatever debt that you have that is overwhelming you, a lot of times they work with you. There is no reason to avoid conversation or communication with your financial institution. It's prudent, really, to make sure that you're having open communication with them and letting them know what your financial position is so they can work with you. That's the first step. Excuse me. The second step then, if that is not an option, is find a financial institution, even outside of your own organization, that would allow you to consolidate all the debt that you have. And they are out there. We'll talk about some of the process of going through this and how it looks, so that you can prepare for it if you're considering that as an option as well. So, excuse me. So consider that. Consider the debt consolidation if you're in a situation where you're just overwhelmed and you have a lot of unsecured debt and you cannot get out of that situation. So why consolidate your debt? Lenders cite 3 primary reasons for debt consolidation. If you go to a company talking to them about consolidating your debt, it's just simplification. It's simplifying what you have. So just managing your debt in a different way, different rates, monthly payments are better. You get a different due date that maybe is aligned with your pay period, and your payments. You have one payment for all your unsecured debt. You have it in one payment. So you simply, instead of having 5 credit cards out there, or 5 unsecured debts out there, or 3 loans out there, they're scattered here and there, it's all simplified into one loan with one monthly payment, and you're able to meet that monthly payment. So you want to be sure that even with that simplified term or the simplified loan, that you can afford that. Then, of course, we talked about lower payments. So when you simplify this, that means that if, let's say, you are paying $500 a month on all your unsecured debt, then the consolidation would allow you to lower your rate, hence lowering what your monthly payments would look like. So you most likely are not going to pay $500 a month on your unsecured debt any longer. Excuse me, your payments will be lower because your rate is lower, you have a better term. Maybe you've even negotiated with your credit card companies, and if you're paying them in full, they would take less payment than what you previously would have paid. So you just want to use all these options that are available out there while you're looking at consolidating your debt, so that you can come out as a winner. You can come out of there clean. And then there is a better credit score. I can tell you that when you first do your debt consolidation, it may not always look clean from the beginning. Your credit score may not look good in the beginning, but just be patient. Be patient, because it does get better. You know, once you do if you do your consolidation with the financial institution, most likely they will close out your credit cards or your secured debt, which is fine. I mean, you really don't need it if you having if maybe you're not able to manage not spending again. You don't want to get back into debt again. So the best thing to do is maybe close some of them out. I wouldn't always advise you to close your credit cards out, because it will reduce your credit score. But in this situation, you're getting into a program to get out of debt. You're not looking to keep accounts open so that you can go spending again. Maybe you can keep one card open if your financial institution or your fintech or whoever you're doing your debt consolidation with allows you to do that. Sometimes they don't, they will not, because they want to be sure that you're going to pay them back, and they want to be sure that they do not create an opportunity for you to go back into debt again. So a lot of them will pay those companies off, and they will make sure the card is turned off, is closed. So you want to be prepared for that too while you're considering doing a debt consolidation. So then some people would say, then why not do a debt consolidation? What are the risks? What are some of the reasons why someone would say, it's not a good option for me? Okay, so people with relatively good score would go. So I mentioned earlier that your credit score can be affected, but another reason why some people may shy away from not doing a debt consolidation is because they say, I don't have good credit score, which, yes, it's true. Some of the consolidation companies will require that you have at least a credit score of 660 and up. So some people may shy off because they don't have a good credit score. So they may not be a good candidate for consolidation, right? For debt consolidation. And sometimes they may say, okay, we're only going to consolidate your credit card debt. And there may be some other debts like a car loan or mortgage that is really the problem for them, but they may have just 2 credit cards and they don't see why they should consolidate those 2 credit cards, which is fine too. If you have the larger debt, you cannot really do your car loan and your mortgage, so to say, under the debt consolidation. That's not unsecured debt. So you can't really do. Most consolidation companies will not do that. So you want to talk to your financial institution that's financed your car, and you want to talk to the financial institution that's financed your home, and work out a different program for them. This debt consolidation program is more so for somebody who's overwhelmed with a lot of unsecured debt. Car loan is secured by a car, a mortgage is secured by a house. So those ones, you cannot consider those for the debt consolidation program. Even the student loans, you cannot consider those for debt consolidation program, because student loans typically have lower rates. If you have several student loans out there, you can actually consolidate them through the federal website. There is the financial aid federal website that you could go and apply for debt consolidation and put all your student loans under one program at a lower rate. So you want to also consider that as an option. What this debt consolidation does for you is just focus on your unsecured debt, except for those debts that have collateral, and those student loans or other federal loans that you may have out there. You may want to deal with them directly for that. But unsecured debt, yes, can qualify for this program. I have seen where people who owe money on their taxes they also include that in their debt consolidation. So you want to be sure that this program really works for you. and that it will get you out of the financial jam that you're in. And who can apply? Who can apply for this debt? The worse your financial situation, is, the less likely it is that you can do a debt consolidation. We talked about the credit score, so there's also the debt to income ratio. If you have too much debt versus your income, that can be a little challenging. If you credit, we talked about if the other issues with your financial institution, your financial situation, which only you know what your financial profile looks like. So you really want to check with the debt consolidation company and let them look at your financial profile. Let them see what your debt to income ratio is. Let them see what your credit score is. And then let them see what your total unsecured debt is, and see what you're looking to consolidate into this debt, and see if what you're looking to consolidate in your other financial profile makes sense to qualify for this program. Again, it's about communicating with your financial institution and communicating with the fintech company or whoever you're talking to about your consolidation. And then what debt can you consolidate? We've talked about that. We talked about credit cards, medical bills, personal loans, payday loans, all these unsecured debt. Yes, medical bills, you can consolidate those, but I'll talk about medical bills again when I get back to a conversation on credit. I did introduce you to a credit conversation here recently. I will explore a little bit more about dealing with bad debt and dealing with rebuilding and building credit here in the future. And so you want to subscribe to my YouTube video, Lydia Tate, so that you don't miss any other sessions that I'm speaking on. I've done a lot of these financial seminars over the years, and COVID has kind of tied me down to do it from home this year. So I want to be sure that you don't miss out if you're interested in learning some of the things that we've talked about in the past and what we're talking about here currently with the pandemic hitting many people financially. So you want to talk to your financial organization to make sure that you do qualify for this consolidation, and that your debt qualifies for it. Then we also, when can you apply for debt consolidation? As we are on my next the next 6 W's. I've already talked about a few of them, so now I'm on the when can you qualify for it. So before pursuing debt consolidation, ask yourself if it's necessary. Is this necessary? Is this really going to make a difference? The Consumer Financial Protection Bureau, which I've referred to many times here, recommends you first make an attempt to work with your financial institution. And with anything in all your financial decisions, you want to have a conversation with your financial institution first, or your debtors, and see if they can work out a plan for you. And you also want to be sure that before you consider this option, that you do enough research on who you're working with or what organization you're working with, and make sure they're reputable, make sure that they are with the Better Business Bureau, make sure that they've actually helped other people and it's worked out okay. Make sure that their fees, if they're charging you fees, is decent, and that they're not paying more than what your debt equals to, for instance. Because you could pay off your debt instead of paying an organization to help you get out of debt. So I've seen some crazy things in the business over the years. So you just want to make sure that you're working with a reputable company, and that the company that you're working with, their values are aligned with your values, and that they can actually help you attain your goal, your financial goal of getting out of debt. So again, I mentioned that you could talk to your financial institution. You can talk to a fintech organizations. Just Google fintech debt consolidation and see who's out there. If you have a good credit, consider maybe getting another credit card and doing a credit card with 0% interest, maybe a promo rate for 12 months, 18 months, 2 years, or whatever, at a lower rate. There are many out there that are doing 0% interest rate, and consider those to transfer your unsecured debt into those, only if you're sure that you have a plan and that you're going to be able to pay off this debt during the period of the promotion. If you're not going to be able to pay it off during the period of the promotion, then maybe just do one. One of your debts. If your income is enough to work with your other financial institutions to pay off your other debt, and you have one credit card or one secured debt that you can roll into this new card, then consider that, but pay it off within that period. Because guess what? After the promotional period, you'll be back to the 18%, 14%, 21% on your credit card, and then you're back to square one. You're back to where you started off. So you want to keep those as options out there and see what's available and how you can help yourself. It's just a matter of finding the right information, finding the right resources, and understanding how to do what you're supposed to do to get out of debt. So I've mentioned this several times, the debt relief program. So I'm not going to spend time on it. Go back to the YouTube video on the debt relief program and see how it works and see if that's a better option for you. The debt consolidation is a better option if you're not in a really, really bad situation. If you're in a place where now you just can't make any payments, you don't have income, consider the debt relief program or even a bankruptcy. I don't promote any of them. I'm just sharing information out here with you to tell you that there's help. You don't have to stay where you are. Your financial situation can change in a year. It can change in 2 years. It can change in 3 years, but you've got to start today. You've got to do something about it today. You've got to work on it today so that next year is a better year for you. The year after next is a better year for you. If you're looking to own a home, you can be a homeowner in the next year. You can be a homeowner in the next 2 years. I can guarantee you this, that if you take up some of the steps that we've shared, some of the steps that I've shared, and some of the programs that are out there, or just reach out to us, reach out to me, and let me help you. Let me help you achieve your goal, guide you, and show you how to get there. You'll thank yourself. You'll thank yourself for going through some of these programs that we're talking about and finding ways to improve your financial situation. We all want the American dream. We all want that house, and we all want that car, and we all want to be able to take care of our families back in the continent of Africa, or even here in the US. We all want to give back to our community. So there are ways that you can do that by helping yourself get into a better financial situation. So consider some of these resources that I'm sharing on my videos, and let me know if I can help you further. So then the question is, how do you consolidate your debt? How do you do this, right? I think this is a really, really good lesson on how to consolidate your debt. I will go to what I call the 9 steps of debt consolidation. The 9 steps of debt consolidation. So first, you determine if you're a good candidate for debt consolidation. Are you a good candidate for debt consolidation? So you typically need to have an okay credit, which we've talked about, which is about 660, and come in under 50% of your debt to income ratio. 50% of your debt to income ratio. 50% of debt to income ratio is pretty high. If you go to a financial institution and you're trying to buy a house, for instance, or you're trying to buy a car, your debt to income ratio cannot be at 50%. There is a number of figure that different financial institutions look at. So 50% is just ridiculously high. So you don't want to have so much debt like that. But if you do, you can qualify for this debt consolidation. Okay? And then the other one, the next step is you have to sum up all your debts. So you ask yourself, am I a good candidate? Then you make a list of all your debt, all your unsecured debt, and then you have to also ask yourself, how soon do I want to pay off this debt? Do I want to pay it off in a year? Do you want to pay it off in 2 years, in 3 years? When you're talking to your debt consolidation organization, have this conversation with them. Make sure that whatever amount of monthly payment that you're agreeing to makes sense to you. Makes sense to you, makes sense to your budget. You don't want to continue stressing yourself. Sometimes we can get a little bit too optimistic about our financial goals and then find ourselves in the same bind, find ourselves in the same situation where we started. So you want to be sure that you find a very comfortable monthly payment that works for you. And then you also, actually typically the amounts that I see for debt consolidation in the industry range from somewhere between $5,000 and $20,000. 30,000, but it has to be, like I said, it has to be unsecured debt. And there are many variables that go with this to find out if you qualify, like I mentioned in our first step of who qualifies for it. So you want to be sure that you are very open with whoever you're working with and that they guide you correctly so that you can make an intelligent decision for yourself. Okay, so you've listed down all your debt. You now understand that you can actually qualify for this debt consolidation and decide which loans to consolidate. Because I mentioned earlier that typically we will not consolidate. The banks, financial institutions will not consolidate car loans or mortgages. They would look at your credit cards, they'd look at your personal loans, they'd look at student loans, medical bills, and some payday loans. So debt consolidation works mainly for unsecured debt, like I mentioned earlier. And there's a survey that was recently done by US News and World Report. And that survey, the findings were that most consolidation companies see 51% of credit card debts being consolidated. They see 23% of personal loans being consolidated, 15% of student loans being consolidated, which again, you have to use a different channel for that. Medical bills is about 13.5%. Payday loans about 8.2%. I'm surprised that we still talk about payday loans. I have reservations about that. I think that payday loans, just the interest rates with that is just astronomical, and I don't think it just makes financial sense to consider that. Not downing anybody who's ever considered that option before, but it's one of those that unless you absolutely have no choice, it's just not a good financial decision for you in the long run, because those interest rates legally, they are very high, and they are legally allowed to charge those higher rates than what you pay on your credit card. So I would not necessarily encourage anyone to run too fast to do payday loans, even though they're a good option when you I wouldn't even say a good option. They're an option when you absolutely have to do them. But this is kind of what surveys show that's out there. So you see already the credit card debt is at 55.8%. That's a pretty high percentage. So a lot of times we get in trouble because of a credit card debt. I will always say, if you have a credit card, if you cannot pay it off in full every month, then it's even better you get a personal loan with a fixed rate. With a fixed rate and a fixed term when you pay it off, versus using your credit card debt. I know I've heard of people who get monies from their credit card for a long-term project, and then they're not able to generate cash flow to pay off the debt, and then they end up in trouble. So if you're thinking about a long-term project, have a conversation with your trusted advisor, your banker or your attorney or your CPA or whoever your trusted financial advisor is. Have a conversation with them and see what options are out there given your own individual financial profile, and see what kind of counsel you get to be able to move forward with that long-term project. I would not consider credit card as an option for a long-term credit project. Credit cards are supposed to be paid off in full every month, and we all are guilty of carrying balances over the years, but we can actually change our behavior and get better and improve our financial situation. And I say we, I'm talking to myself as well. We can all improve our financial situation by making sure that we pay off our credit cards in full every month. So if we already have those balances, let's strategize in ways that we can pay them off and free ourselves from this cycle of continuously having this debt out there and we're not able to get out of debt. So the fourth step then that we have to factor in, I talked about the 9 steps, now I'm on the fourth one. Factor in the lower interest rates and longer repayment terms, because you don't want to. I said sometimes we get aggressive, right? And we say, okay, I want to pay it off in 2 years, but can you really pay it off in 2 years? Do you have money saved up in your savings account where now you're just going to take, if your credit card debt, if you were paying $500 a month, do you want to continue paying the $500 a month? Can you maybe find a way to have a lower rate on this consolidation debt where maybe you're paying half of it or even less, and you have some cash flow that you could put towards a savings account and build up your savings account or your retirement account, or are you going to just take all this money and throw it into the consolidated debt? Now that's actually not bad, but you want to make sure that your term makes sense. So if you have extra money, you can throw it into the debt consolidation, you can pay all on this loan, but you don't want to set yourself up for failure by having an extremely high monthly payment. You'll be here after 2 years, you'll be here after 3 years, you'll be here after 5 years. If you're not here, nobody's going to collect on that debt. So think about that. But give yourself a break on what you're paying if you consider debt consolidation as an option. So, again, when you're talking about factoring in your interest in your monthly payment, consider if you're looking to do a secured loan or unsecured loan. A secured loan is where you'd look at maybe getting cash out from your mortgage if you have equity in your home. You want to talk to a bank to see if that equity or home equity line of credit is even an option. There may be one or two financial institutions that I know that since the pandemic began are not even open to doing a home equity line of credit, but there are other institutions out there that are open to doing that. So you want to investigate who has the best program for you and make a decision to work with them if you have equity in your home, that is. So if you've been in your home for a long time and you're in debt, this would be a great time to get some cash out of your property and consolidate your debt. You'd be surprised that your mortgage payment, your home equity line of credit payments will be extremely affordable, and you'll be able to restructure your debt in a way that it makes sense. But again, I'm going to say, I give you these options. I will always stress on this, that your house should be the last thing you touch, really. I mean, that's where your family is, that's where you are. So unsecured debt, if you absolutely can find a different option, do that. Consider that versus using your home to get cash out. I'm sharing this information. I'm being very candid with what I know makes sense. Let that be a last resort, for instance, before you look at you find other options before you look at using your house, using getting cash out to pay off your debt. But for some people, it makes sense, it works for them, and they're able to pay that debt first. If it works for you, fine, it's an option, a great option, as a matter of fact. Then the unsecured option is what we've talked about, where you go to a bank and they give you an unsecured debt, and you pay off your unsecured debt, but you possibly get a lower rate in a better term, and you're able to pay it off first. So you get a shorter term, you get a lower rate, or you get a longer term. Sometimes if your credit is not up to par, the financial institution will still consider giving you a consolidation loan, but unfortunately your rates may be higher than what it would be for somebody, for instance, who has a 660 credit score and higher. So you also want to be aware that if one person does the same thing you do, and maybe their rate is 10% hypothetically and yours is 25%, it could be that there are some variables in your personal profile, your credit score, or something, or even they may even be using something as collateral for their financing, and you didn't provide collateral for your consolidation. So you want to not necessarily compare what the other person is getting versus what you're getting, because each individual is unique. Each individual situation is unique, and I can tell you, most financial institutions are regulated, so they are very careful to do the right thing by you. So you want to be sure that you really getting the right resources and doing the right research and working with the right debt consolidation organization. Okay, there are other tools that you can use online to see how your payments would look. What if you have $25,000 in debt, you paid over a six-year period. Look and see at a certain rate, play around with it, so that when you do go to the bank, you know what you're talking about, you know what you're looking for, and you negotiate with different financial institutions until you get the program that works for you. But again, you don't want to go to everybody and get your credit pulled. So you just want to do enough research before you select which financial institution you're going to be working with. You can call, you can schedule appointments, you go talk to them, can do different things so that you get the right information. And then the number 5 then is choosing the right consolidation option. Again, we've talked about them already. Your personal loan, you can get a personal unsecured loan, you can leverage your home, you can transfer credit card balances, or you can even look at the debt relief program that we talked about, the debt relief companies. But again, with the debt relief companies, you want to be sure that you call the Federal Trade Commission. You want to make sure that you follow what the Federal Trade Commission says. Call and make sure that it's a reputable company. Do research. Look at Better Business Bureau, like I mentioned earlier. Make sure they're a credible company before you do that. Then determine your new monthly bill. Make sure that your new monthly bill makes sense. Make sure it makes sense. Make sure that your total monthly bills now make sense with the consolidation. And I'd say this, even if your payments are cut into half, your total monthly bills may still not make sense. So you still have to make a life adjustment. You still have to change your behavior. You still can't go shopping left and right. You may want to shop around on your utility bill or shop around on your electrical bill and see who's better option. If you live in a community where there's a monopoly, like in my community, then you have to wait for competition to come in, and then it's a shopping around for somebody who will give you a better deal on your utilities and on your utilities and on your light and your water and other expenses that you may have, your internet services. You want to look at those and make sure that they're making sense on your budget. Also, just look at your whole budget and see where you can make adjustments as you consolidate your debt. If you have to get rid of some expenses, get rid of them. And now we have to have internet because everybody's working from home. If you have a home phone and it doesn't make sense, get rid of it. If you have cable and it doesn't make sense, get rid of it. My kids tell me all the time that nobody has cable anymore. So if you have internet, you have access to pretty much everything that you need to watch online. So I think I disconnected mine when they challenged me on not having to pay for for cable services. So just look at those as an option. Look at the different parts of the budget that you need to change and see what behavior you need to change as you do your debt consolidation. And then the next step is you do a reality check. Your reality check is, does this make sense? Is this going to help me long term? Check with your creditors directly to see if you can negotiate lower rates first. We talked about that. You might also want to consult a nonprofit counselor on how to consolidate debt, or talk to a mentor or financial coach and see what you can do. This is where people like me and other financial coaches come into play, where somebody can advise you on what works for you. Now, what works for friend A may not work for friend B or may not work for friend C, and that is why you have to have an individual conversation with a coach or a counselor or a nonprofit organization that's out there that can assist you with what you have, or whoever you choose is a trusted advisor, and see what they have out there that can make a difference for you. Then take out the loan. Once you've looked at all this, take out the loan, pay off your debts, and then again, make sure that you're changing your behavior on your budget, because if you don't change your behavior on your budget, you're going to be back to where you started. It's going to be a cycle. You're going to pay off your debt, and then you're going to go back to square one again. You're going to start looking at other ways to get out of debt again, but get back into worrying, getting back into anxiety. I mean, you just don't want to do that. So because when you consolidate your debt might be the best thing for you. And if that's the case, you should just congratulate yourself and take a big step and do it. If it's the right thing for you, do it. You'll find that it will help you just have financial peace. It's good for your financial well-being if it makes sense, and you'll be able to improve your credit score. I know people who've gotten into the program and they were able to purchase a home in a few years, even while they're still in the program. Because once the program is approved and you've consolidated your debt and you're making payments, it shows its current payment history on your credit score. I know somebody who did a debt consolidation and now their credit score is at 700, but they're still in the debt consolidation program and they've been able to purchase a home. So it's not necessarily a bad thing to do this debt consolidation. The debt relief program is just one that you do when you absolutely have to do it. But the debt consolidation program may make sense for you if you have a lot of unsecured debt and you don't have the cash flow right now, or you have more income than less income than your unsecured debt, for instance. This could be a good option for you. And it's not prison sentence. It's just a restructuring of your debt to help you get out of debt, to just help you relax a little bit, and to just turn your financial situation into something a little more positive, right? So, but again, you want to do your research. You want to make sure that this is a good option for you. We can talk to a financial coach. You want to talk to your financial advisor to see if this is a good option for you. So that is what I have for you today on debt consolidation. If you'd like to learn some more about debt consolidation, or you'd like to speak to someone about your own personal information or personal debt, and to see what the best option would be for you, just send an email to coaching@lydiaspeaks.com. I'm also going to have that information down there on the YouTube message, coaching@lydiaspeaks.com. Or you could go to lydiaspeaks.com on the website, and there's you could sign up through there and send us your information. We will reach out to you and have a conversation. We can schedule time for us to talk. You can also find me on Facebook, Lydia Wanyanga Tate on Facebook, and we can talk through your situation and help you get to a better financial situation. Thank you, and I hope that you have a pleasant Saturday. Have a good day. Thank you.